On Sunday, February 8th, United States Treasury Secretary Scott Bessent appeared on Fox News and pointed his finger directly at China. Silver had just crashed 33% from its all-time high. Gold had pulled back from record levels. Billions in wealth had evaporated in a matter of hours, and Bessent had an explanation ready. He called it a classical speculative blow-off driven by unruly Chinese traders who had been forced to liquidate when Beijing tightened margin requirements. Case closed. The speculation got out of hand, the Chinese regulators pulled the plug, and the correction was healthy. That was the official story from the man in charge of America's finances. 48 hours later, Bloomberg published a report that changed the entire frame. On February 9th, unnamed sources revealed that Chinese regulators had quietly instructed the country as major commercial banks to stop purchasing new United States Treasury bonds and to gradually reduce their existing positions. These banks collectively hold approximately $298 billion in American debt instruments. The directive was described as prudent risk management, not an escalation. No forced sale quotas were set, no deadlines were announced, but the timing was impossible to ignore. The most powerful economic official in America publicly accused China of destabilizing global metals markets. And within 2 days, Beijing responded not with words, but with a direct financial maneuver aimed at the foundation of American fiscal power, the Treasury bond market. This is not a story about silver prices or gold charts. This is a story about what happens when the two largest economies on Earth start using financial markets as weapons. And to understand what comes next, you need to see the architecture that makes this confrontation possible. The United States government borrows money by issuing Treasury bonds. Every week, the Treasury Department holds auctions where investors, banks, and foreign governments purchase these bonds, effectively lending money to Washington. In return, they receive interest payments and the promise that the full principal will be returned at maturity. This system works because the entire world treats U.S. Treasuries as the safest financial asset in existence. That perception is not just a market opinion. It is the foundation upon which the global dollar system operates. Foreign governments collectively hold approximately $9.4 trillion in U.S. Treasury securities. Japan leads with $1.2 trillion. The United Kingdom sits at $888 billion. And then there is China. At its peak, China held more than $1.3 trillion in American government debt. That number has been cut nearly in half over the past decade. As of the latest Treasury International Capital data, for November 2025, China's official holdings sat at approximately $888 billion, with a trajectory pointing firmly downward. For decades, this arrangement served both sides. America got cheap financing for its deficits. China got a safe place to park its enormous trade surpluses, and a way to manage the value of the yuan against the dollar. The relationship was uncomfortable, but functional. When you owe the bank $1 million, the bank owns you. When you owe the bank $1 trillion, you own the bank. China and America have been locked in that paradox for a generation. What changed is the trust. In 2010, foreign governments held roughly 40% of all outstanding U.S. Treasury debt. Today, that figure has fallen to 15%. J.P. Morgan's former deputy chief of staff to Treasury Secretary Janet Yellen, Gengar Bunanat, recently warned that investors should be concerned about this structural shift. The private sector has stepped in to fill the gap, but the signal is unmistakable. The governments that once formed the bedrock of demand for American debt are stepping back. Scott Bessent understands this vulnerability better than almost anyone in Washington. Before joining the Trump administration, he spent 3 decades on Wall Street, including a stint managing money for George Soros. He knows what happens when confidence in sovereign debt erodes. He knows that the perception of safety is the only thing separating U.S. Treasuries from every other piece of government paper on the planet. And he knows that if China's exit from Treasuries accelerates, the consequences reach far beyond bond yields. Now, let us trace the sequence of events that turned a metals market correction into a geopolitical confrontation. In late January 2026, silver hit an all-time high of $121 per ounce. The rally had been building for months, driven by industrial demand, supply deficits, and a global rush into hard assets. Chinese retail investors were heavily involved. The UBS SDIC Silver Futures Fund in China had been trading at a staggering 36% premium over its net asset value. Leverage was extreme. When Chinese authorities raised margin requirements, the unwind was violent. Silver lost nearly half its value in hours. Gold pulled back sharply. The margin calls cascaded across global exchanges. This is where Bessent stepped in. On Fox News, he characterized the entire episode as a China problem. His exact words: "Things have gotten a little unruly in China. They are having to tighten margin requirements. So gold looks to me kind of like a classical speculative blow-off." The framing was deliberate. By attributing the crash to Chinese speculation, Bessent accomplished 2 things simultaneously. He deflected attention from the structural weaknesses in COMEX delivery mechanics that this channel has documented extensively. and he positioned the United States as the adult in the room, the stable anchor in a volatile world. If this analysis helps you see through the headlines, subscribe now and hit the notification bell. Because the Chinese response that came 48 hours later tells you everything about where this is heading, China's Global Times, the state-affiliated newspaper that frequently serves as a mouthpiece for Beijing's geopolitical messaging, called Bessent's claims groundless. They pointed out that margin requirement adjustments are standard risk management across all exchanges globally, including the CME in Chicago. But the real response was not in the newspaper. It was in the Bloomberg report. The instruction for Chinese banks to limit Treasury purchases and reduce existing holdings was not improvised. The Atlantic Council, in an analysis published today, noted that this directive had reportedly been in place for weeks before the Bloomberg leak. The timing of the leak itself appears to have been the message. It came less than a week after Chuxi, a leading Chinese Communist Party journal, published a 2024 speech by President Xi Jinping explicitly calling for the internationalization of the yuan. And it came days after Bessent told Congress about rumors of Chinese digital assets, possibly backed by gold, that could be used to build an alternative to American financial leadership. Beijing was not reacting to Bessent's Fox News appearance. It was signaling that the financial decoupling is already underway, and that America's public accusations will be met with quiet but consequential financial moves. The China story is dramatic, but it is not happening in isolation. Pull back the lens, and you see a coordinated pattern across the entire BRIC bloc. Brazil held $229 billion in U.S. Treasuries in November 2024. 12 months later, that had fallen to $168 billion. A 27% reduction in 1 year. India went from $234 billion to $186.5 billion, a 20% decline. China shed $86 billion in the same period. In a single month, November 2025, China and India together offloaded $10.3 billion in U.S. government debt. ING's global head of markets, Chris Turner, summarized the trend in December. BRIC countries are quietly leaving the Treasury market. Quietly is the operative word. There have been no press conferences, no formal announcements, no declarations of financial war. Just a steady, month-after-month reduction in holdings that collectively represents hundreds of billions of dollars flowing out of American government debt. Meanwhile, something extraordinary happened in late 2025 that received almost no mainstream attention. Gold's share of global central bank reserves surpassed U.S. Treasuries for the first time since 1996. Central banks around the world have been buying gold aggressively for 15 consecutive months. China's government has been a net purchaser of gold throughout this entire period. The shift is not speculative. It is institutional, it is strategic, and it is accelerating. Now connect the dots. Bessent accused Chinese traders of destabilizing precious metals markets through speculation. But Chinese institutions, at the government level, have been doing the opposite of speculation. They have been systematically accumulating physical gold while simultaneously reducing exposure to dollar-denominated debt. That is not reckless trading. That is a national strategy of financial repositioning. And Peter Schiff, the economist, who has been warning about dollar debasement for 2 decades, responded to the Bloomberg report with a prediction. If China stops buying treasuries and the Federal Reserve has to step in to absorb the supply, consumer prices will soar. Schiff's track record is imperfect, but his logic follows directly. When the largest foreign buyer of government debt steps back, either interest rates rise to attract new buyers, or the central bank monetizes the debt through money creation. Both outcomes are inflationary. Both erode the purchasing power of the dollar. Both accelerate the very dynamic that is driving investors and governments toward gold and silver in the first place. Drop your analysis in the comments. I want to know what you think this means for the dollar, because the data points in one direction, but the implications split in ways that deserve real debate. Here is what nobody in the financial press is connecting. Scott Bessent blamed China for the silver crash on February 8th. Bloomberg reported China's Treasury pullback on February 9th. But these are not two separate stories. They are two fronts of the same financial conflict, and precious metals sit at the exact intersection. When Bessent called the metals sell-off a speculative blow-off, he was defending the credibility of dollar-denominated paper markets. The narrative he needs the world to believe is that gold and silver surge because of irrational exuberance, not because of fundamental distrust in American fiscal management. If the market concludes that precious metals are rising because global confidence in U.S. debt is deteriorating, that conclusion becomes self-reinforcing. More selling of treasuries, more buying of gold, more pressure on the dollar, more reason to sell treasuries. China understands this feedback loop, and the timing of the Bloomberg leak suggests Beijing wanted Washington to understand that China understands it. The directive to limit treasury purchases was described as prudent risk management. But in the language of geopolitical finance, prudent risk management by your largest creditor is the most polite way of saying we are reducing our confidence in your ability to repay. The United States currently borrows approximately $43.5 billion per week. Interest payments on the national debt are on track to exceed $1 trillion in 2026. The system requires a constant inflow of new buyers to sustain itself. If foreign governments continue their retreat, and if China formalizes what has been a gradual divestment into an explicit policy of reduction, the Federal Reserve becomes the buyer of last resort. That scenario is not hypothetical. It has happened before. It is called quantitative easing. And every previous round of quantitative easing sent gold and silver prices substantially higher. The Danish pension fund Academic Pension recently announced plans to offload its U.S. Treasury holdings entirely, citing credit risk tied to fiscal and political upheaval. A European pension fund publicly questioning the creditworthiness of U.S. government debt would have been unthinkable 5 years ago. Today, it barely makes the news cycle. There are 3 scenarios to watch from here. In the first, the Bessent-China exchange is a one-time spat that fades as both sides step back from escalation. The expected Xi-Trump meeting in April 2026 provides a venue for quiet de-escalation. Treasury markets stabilize. This is the base case most institutional analysts are working with. In the second scenario, China's treasury reduction accelerates. The directive to banks expands from a suggestion to a mandate. Gold purchases increase. Other BRIC nations follow more aggressively. The dollar weakens, bond yields rise, and the Federal Reserve is forced into a policy response that effectively monetizes the deficit. Silver and gold benefit enormously in this environment. In the third scenario, the one that keeps Treasury officials awake at night, China moves beyond passive divestment and begins actively using its financial position as leverage in trade and geopolitical negotiations. Japan, which holds $1.2 trillion in U.S. Treasuries, recently hinted that its holdings could become a trade negotiation tool. If the weaponization of sovereign debt holdings becomes normalized, the entire architecture of post-war international finance enters uncharted territory. At the beginning of this video, I described Scott Bessent pointing his finger at China on national television, and China's quiet financial response 48 hours later. What that exchange reveals is not simply a disagreement about who caused a market crash. It reveals a fundamental fracture in the relationship that has underwritten global dollar dominance for half a century. One side is publicly assigning blame. The other side is quietly rearranging trillions of dollars. The question every investor needs to ask is not who is right about the silver crash. The question is, which side's actions tell you more about where the world is actually heading? Words are cheap. Capital flows are not. And right now, the capital is moving.